Let's now go to interest rates, and Australia's Reserve Bank is seen to be the first central bank in the Western world to ease up on interest rate rises, despite the risk of rising inflation. But the Reserve Bank of New Zealand, which identified the inflation risk much sooner than the RBA, is not backing off. Today, the RBNZ raised its cash rate by 0.5% to 3.5%, despite rapidly falling home prices. Let's bring in here Nick Tuffley, who is Chief Economist at ASB Bank, based in Auckland. Nick, many thanks for your time. In your note after the RBNZ decision today, you said it's on a path of least regrets. What did you mean by that?
Well, the Reserve Bank has what it's called this least regrets framework, which is, look, if we do something or don't do something now, how much will we regret that in the future? And the moment, what it's balancing is the risk of going too far versus going too slowly. And at the moment, it sees the risk of going too slowly as its biggest source of regret, in the sense that it just may not do enough and it may have to play catch up later on and potentially have monetary conditions tighter for much longer than would be ideal.
Well, the interesting thing about today's minutes that came out, or today's statement that came out, was that the board actively considered raising by 0.75% and has indicated, similar to the Reserve Bank of Australia, that the interest rate rises are not yet over.
It's not the first time that the Reserve Bank has contemplated a 50 basis point rise and a 70 basis point increase. I think probably the surprise is that it did that when the cash rate is already quite high. But when the Reserve Bank's looking ahead, it does have a view at the moment that it's just not quite done yet. And we're likely to see at least another 50 basis point increase before the end of this year.
Okay, so tell me, where do you think the peak of these cash rates in New Zealand lands? Where does it finish up?
Look, our expectation at the moment is 4.25% in the early parts of next year. So that would be 2 meetings from now, November and February. Look, there is a risk that it could end up being slightly higher than that. There's really not the same early signs that inflation pressures are really going to be coming down substantially. A lot of the indicators are still pointing towards a lot of red-hot inflation pressure in the near term.
You raise a subtle difference between Australia and New Zealand there, and we should point it out, and that is that the Reserve Bank of Australia meets every month, whereas the Reserve Bank of New Zealand, such as the Federal Reserve in the United States, do not meet every month.
Yes, the Reserve Bank of New Zealand has 7 meetings a year, so it doesn't have quite the same luxury that the Reserve Bank of Australia has, with meetings basically every month of the year. The Reserve Bank, in terms of lifting 50 basis points, it's doing that pretty much every 6 weeks at the moment, and it does take probably a little bit longer to get the cash rate up unless you do these large movements.
Okay, so then explain to me just what impact the rate moves to date are having on the New Zealand economy. Is there evidence yet that the inflation is being stripped out of the economy?
We've probably seen inflation peak in a headline sense, but a lot of the core inflation measures remain very elevated. We've only really just started to see some tentative signs that some of the labour shortages may be starting to ease. So everything's very tentative on the inflation front. And to date, the main impact that we've seen of higher interest rates has been on the housing market, where we've seen clear signs of softening since late last year, which is just coincidentally after interest rates started to go up.
And what about the narrow path that the Reserve Bank and other central banks talk about, the prospect of tipping the economy into recession while it's actually trying to scrub out the inflation?
Well, the Reserve Bank's view is it doesn't need to be pushing the economy into recession to achieve its objective. And actually, encouragingly, the signs we're seeing is that activity is still growing as we move into the second half of this year, after a pretty healthy rebound in the second quarter of last year, where the economy grew by 1.7% in that quarter. So, the Reserve Bank's intention is not to push the economy into recession, but obviously when you're lifting interest rates in large movements in a short space of time, so every central bank around the world that's doing that is doing it with that sort of uncertainty about how quickly and how potent the impact of those rate moves will be.
Nick Tuffley, Chief Economist at ASB Bank, based in Auckland. Many thanks for your time today.